guys, listen to me, okay? What I want to try to do is I want to try to give you simple understandings of different loan programs. We have many of them, okay? And then after I explain the loan program, I'm going to tell you what is the highest and best use for that program. And right here is going to be our first program right here. We are using the FHA First Time Homebuyers Program and the FHA 203K program. They're FHA, they're both programs. We have to do them, okay? And they're always good for a first time buyer. So let me tell you some of the facets to this loan, all right? And what's good about this loan is if you're a new investor and you've never bought anything and you have verifiable income, okay, which is either your tax return or your W-2, you have a bank statement, and then you're going to qualify under the debt to income ratio, okay? And that's what's called DTI, debt to income ratio. So you're going to have to show this. You're also going to have your credit pulled, okay? And your credit can be anywhere north of 500. Yeah, it can be north of 500. Doesn't have to be that much north of 500, but 500, you can still get a loan this way. I know everybody says the minimum is 580, the minimum is 620. It's not, okay? I've seen people get financing with a credit score of 500. So this loan program is backed by the U.S. government, okay? And FHA stands for the Federal Housing Assistance Program, okay? Or Federal Housing Agency, FHA, all right? And that's pretty much who does most of the lending in this country. We're gonna have some products that are non-FHA or non-government backed, okay? This loan will allow you to buy a property with just 3.5% down, which means you can finance 96.5% of the property, okay? That's 96.5% loan to value, okay? That's supposed to be a V, all right? And perfect for a first-time home buyer, okay? Now here's the caveat. You've got to live in there for at least 12 months. And when you're living in there for 12 months, then you can actually build up the equity, create some value, and let's just say that you don't buy a single family. Let's say you buy a two-family, and that two-family has income of the additional unit. Most likely that is going to pretty much defray the cost of your rent. So you're going to buy a two-family, it's going to have a second unit, you're going to live in one of the units. I would suggest if it's an up and down, you live in the top because the bottom floor is more desirable. And you put some dollars into that, you renovate that a little bit, and you increase the value, and that is going to help you to build out some equity. What's also nice is after 12 months, I'm going to suggest that you refi the property and put a conventional loan on, which we're going to talk about a conventional loan product, but you're going to put a conventional loan product on, and guess what? Boom. You go back here and you do it all over again, because it doesn't mean you just have to be a first-time buyer. You can use this program every 24 months. I know it's every 24 months. So every 24 months, once you have used it for the first 12 or lived in it, you can refinance it and you can go out and do it again. So guys, this is the way you build up equity. You do it over and over and over again, and you build cash flow. So let's go. Loan product number 2, conventional loan. It's exactly as it sounds. It's a standardized conventional loan. It's a square peg in a square hole, okay? There's nothing wrong with it. We all use them, okay? It underwrites pretty typically. It's typically gonna be 20% down or more on a deal. It is also government backed because most of the conventional loan players will sell their loans to the government. They will close with their own funds. They will use a line of credit. They will table fund it, and then they will sell it off to the government in big blocks. All right? So they're fitting a guideline. They have an underwriting guideline, a metrics that they have to fit into the box, okay? And that's going to have all stated income. So you're going to have show your W-2 or your tax return. Okay, everybody knows what a W-2 is. Your tax return. You're going to have to show that income for 2 years. Bank statements. Money just can't magically appear into your bank statement. You've got to have it there for the last 90 days. Okay, so you need 3 months of bank statements to show that. Okay, you also have to have normal credit. All right, what is normal credit? Somewhere north of 680. That's what most conventional lenders are going to look at. You can qualify for a conventional loan with a little lower loan to value, and you can also qualify with a little lower credit, but the rate may be higher. Okay. Lastly, we're going to use a 20% down, and our rate is going to be somewhere around prime plus 1% or 0.5%. It all depends on how you underwrite.
And what is prime real quick?
And prime is the prime borrowing rate. Okay, banks lend out at prime. They borrow at the discount rate from the Federal Reserve or the Federal Home Loan Bank, and that's how they price out their loans. So banks work on a spread. So if a bank lends you 100K and prime is at 5%, they're going to loan it to you at probably 6.5%, and they're going to pick up 1.5% or 150 bips, which stands for basis points. Okay, guys, this is a super simple process. Okay, the only way for you to get off the sideline is to get in the game. Okay, what's going to end up happening is you're going to create a relationship with your real estate agent. That agent is going to introduce you to a really good qualified mortgage broker. That mortgage broker is going to hold your hand. They're going to analyze your deal, and they're going to tell you this is the best way to finance your deal. Whether it's a first-time home buyers program, or it's hard money, or it's FHA with 203K, or whether it's straight up conventional, or the next product we're going to talk about is a DSCR loan, debt service coverage ratio loan. Okay, see you right back here. Loan product number 3, guys. This is going to be your friend. Okay, it's always been my friend. This is a debt service coverage loan. Okay, and I've just used the acronym up here, debt service coverage loan, DSCR. Pretty hard to say 3 times fast. DSCR, DSCR, DSCR. Now say it long form. Debt service coverage loan, debt service coverage loan, debt service coverage loan. I did it. That's because I've only had 7 shots of tequila just now. Okay? Because I want to steady my nerves. But listen to me, okay? Guys, this is the investor friend, all right? This is the loan that when you do your first one, you're going to get a very touchy-feely feeling with this lender. These lenders are private. This is not government-backed. So these are hedge funds. These are non-bank banks. These are publicly traded mortgage companies. These are people that understand real estate at a level that we all wish and aspire to, all right? And these guys are going to show you a path to becoming a real estate investor. So here's what it is. It's a private loan by a non-backed government agency, okay? You do not need any personal income, none whatsoever. It's all based on the income of the property. And I'm gonna actually come right down here and explain to you why this works so well. The debt service coverage ratio loan they'll verify your NOI, which stands for net operating income. That is the income after all the expenses, an applicable reserve, and that is what you have left over to service debt. They will then take the annual debt service, okay, on what you're looking to borrow, and they will see if it underwrites, and there's going to be a ratio, okay, and that ratio is typically 1.25, all right, which is 125 basis points or bips, which is 1%, and a quarter. Okay? 100 bips equals 1%. All right? So this is how they're going to underwrite it. And if the property has this 125 debt service coverage ratio, and trust me, as you do more deals with these different lenders or this first lender that you do it, they're going to get more flexible. They're going to go down to a 1.2 coverage. Then they're going to go down to a 1.15. They're going to get more comfortable with how good you are. And if you're good, guess what? I borrow my money at a 1.0 coverage. All right? So when you get good, they recognize that. And they are going to follow you from deal to deal to deal. I said this is your friend. Make sure that you are out networking and you know at least a dozen of these lenders because they are all going to bid against each other. You can play one against the other. Let's go. Loan product number 4, okay? This one's my favorite one, okay? This is the loan of last resort. This is the lender of last resort. This is the guy that is going to rip your children out of their bed for collateral to buy a deal. I'm just fucking with you, okay? So listen to me, all right? It's a hard money loan. It's a hard money loan because it's money, right? Or it's just money. Or it's money. Just listen, okay? Hard money loans are all based on sophisticated investors. They have this program. It's called Lend to Own. Some of these guys are out there making loans because they actually want you to source the property and they want you to actually lose the property to them, and they're going to charge you. They're going to charge you through the nose, right from here going out there, okay? But here's what's going to happen. They're private lenders. They're guys you can talk to. They're guys that will come out and look at your project. There are guys that may say, look, I'll loan you 95% of the deal, but I want to have a return of 15%, or I want 10% of the upside of the deal, or I'll partner with you because I love this deal so much, but put the deal in my name, or put it in a trust in case I don't want to foreclose on it. There are so many different ways. Private lenders are super sophisticated investors. Think of it that way. They're going to know more about your deal than you're going to know about your deal, okay? And they're going to know how to get out of your deal the day they lend you the money. So think about it this way. You can most likely do a deal with 10% down. If you have seller concessions, if you have a seller carry, they're not going to give two shits about it. So that's going to allow you to finance 100% or higher. When you find that first good hard money loan or hard money lender, that money guy, okay, that guy is going to want to do all your deals. He's going to want to help you. And here's what's also going to be good. If you are actually doing well and you're executing and you're borrowing his money and then you're getting out of it as fast as you possibly can, okay, let's effing go. All right, you're going to refinance that baby in 3 to 6 months. You've created value and you push it. He's going to say to you, all right, let's do another one. He's going to say to you, I have these 2 deals that I just foreclosed on. Can you help me with them? It's all about building trust from execution. What we're showing you is how to simply plan out the execution, do it, and then do it again, all right? And in hopes that you learn how to buy a 1 up to a 4, and then we're gonna teach you how to scale in the multifamily space. So guys, let's go, let's effing go, let's stop sitting on the sideline, let's stop being a little baby, let's stop whining, oh, I don't have the Lamborghini and my girlfriend doesn't love me and I'm not making enough money. Get off your fucking ass and let's go. All right, guys, so listen, okay, I've given you 4 loan products. There are other loan products. There are other ways to do things, okay? And that's what we're teaching here. We're teaching simple concepts. We're teaching how to get creative financing. You guys call it subject to. We're teaching people how to flip deals. That's wholesaling. We're teaching people how to do short-term rental. We are doing a number of things to help people grow their net worth and create a real estate portfolio. We've given you 4 simple products, okay? Now, once you start to learn the 4 simple products, You're going to layer that with product number 5, product number 6, product number 7. Literally, this is what you need to learn to do in this business. Now, why do we need loans? Guys, okay? We need loans because real estate is all based on leverage. And I want to just erase the board. I want you to stick with me. I'm going to show you how leverage works. This is a simple example, okay? How's my erasing technique? You guys like this? I'm going long erasing, then we got the short, and then we go money, money, hard loan. So listen to me, guys, okay? Here is a simple technique of leverage. I'm going to use some round numbers. I have $100,000. All right? I have 100,000 dollarinos, okay? That 100,000 dollarinos is going to let me buy a home. So let's make a home here, okay, with some windows, okay, and a little doggy up there, and a door, all right? We're going to buy this one home, and it's $500,000. Why? Because this is 20% down. We used a conventional loan. We took out a mortgage of $400K, all right? So we have this right here. I want you to just watch this. So we own an asset worth $500,000. I'm going to take this same 100K, okay, and I'm going to put it with a broker, okay? That's a stockbroker. A stockbroker, that same 100K, and we are going to apply a simple formula. We made 10% a year, right? So if I make 10% a year on this $100,000, my simple math brain tells me I made 10K, right? That's 10% on 100,000. If I take 10% and apply this to this home, which appreciated because we applied this crazy thing called leverage, which I love from the second Wall Street movie where Michael Douglas calls it leverage is banking on steroids, okay? It's banking on steroids. It allows you to lift 400 pounds with just 100 pounds. If we apply that, if we do the math correctly, 10% over here is a $50,000 increase. Would you rather make $10,000 on your money, or would you rather make $50,000 on your money? And guess what? Here's the piece de resistance. You have depreciation, which is tax loss, and you have cash flow. So guys, you not only are making this, you're sheltering some of this, and let's just say we only have 10K in shelter, that goes up to 60K, and you have another 5, you just made 65K, okay, on this investment. So guess what? Your return goes up exponentially. And what's going to happen? That property goes up again, and the same thing happens again, and you apply that principle. And now, because it's real property, you can borrow that. You go back, once it goes up again, you borrow 80%, or you borrow up to 90%. As you become a better risk to the lenders, they're going to give you more leverage. It's like crack to a drug addict. Leverage is crack, okay? Think about it this way. But if you use it in the right direction, if you use it properly, you become a real estate fucking ninja. I've just given you 4 pearls of wisdom. I hope you can understand it. I hope I kept it simple, all right? I'm really trying hard to add value to your life, because I know when I do something good happens to me, and then I can do more good. Changing people's lives is one of our mission statements. It's one of our vision statements here at Shapiro Capital. I want you to click the link below. Let's change your life. Let's rock your world. Let's schedule a time, talk to one of my advisors, and let's go, baby.